guys? Thank you for tuning into my channel where we focus on finance, real estate, and other life topics. Now, if you're new to my channel, please consider subscribing and turning on the notification bell as I am posting new content on a weekly basis. Alright, so today I'm going to be discussing rental property depreciation. Now, just so you guys know, I am a real estate investor in Los Angeles, California, and I currently have a real estate portfolio valued at $1.6 million. I mean, guys, I really believe that real estate is one of the best ways to build your net worth and establish passive income. Now, this passive income can supplement and hopefully one day replace your income as a whole. Now, just so you know, I do have a video on this channel to discuss 4 ways to make money in real estate investing. And I have a link to the video in the description. And in that video, I mentioned depreciation as one of the tools to make money in real estate. So my goal today is to go more into detail on depreciation and how you can benefit from it. But before I do that, please smash the like button to let YouTube know that you're engaged and enjoying the video so far. It really does go a long way in helping to support the channel. Also, I wanted to give a shout out to Jay Invest. He actually commented on one of my other real estate videos and gave me the idea to create a video on the topic of depreciation. So shout out to Jay Invest. He also makes content around finance and real estate, so be sure to check out his channel and show him some love as well. Alright, now when buying investment properties, most people, including myself, focus on cash flow. Now, cash flow refers to the income being generated by the property and refers to how much is left over every month after all of your expenses are paid. Now, in addition to cash flow, which is important, there are greater benefits that are sometimes overlooked, including rental property depreciation. Now, this topic can get a bit complicated, but I'm going to do my best to break it down and keep it as simple as possible for you guys. Depreciation is the loss in value to a building over time due to age, wear and tear, deterioration. It also includes improvements that you made and items inside the property that are not part of the building, such as appliances and flooring. So guys, rental property depreciation allows you, the investor, to write off the structure and improvements to the property over a period of time. By doing this, it's considered an expense that you can use as a write-off on your taxes. Now, just to clarify and to keep in mind, you can only depreciate the improvements to the structure itself, not the land. Depreciation is one of the biggest benefits to real estate investing because it can reduce your reportable net income and therefore reduce your tax liability. But the thing I love about it, guys, it's a double-edged sword. It's a loss on paper to the IRS, but when you go to get loan approval for another investment property, when you go to get additional financing, they look at your taxes and the underwriter will put the income wrote off as depreciation back into your income for qualification purposes. That is huge. I mean, you save on taxes, and it also counts as income when getting approved for additional properties. It truly is the best of both worlds. Okay, so the IRS allows owners to take a tax deduction based on the perceived decrease in value of the property over a period of 27.5 years. So depreciation deductions are spread out over the useful life of a property. The IRS allows you, the owner, to depreciate the value of the property over a 27.5-year span. Now, depreciation is calculated with this formula. So you take the cost of the building minus the value of the land, which equals the building value, divided by 27.5, which equals your yearly allowable depreciation deduction. So it would look something like this for a property valued at $75,000 and land worth $25,000. So you take $75,000 minus $25,000, which would equal $50,000. You take $50,000 and divide that by 27.5 years, it equals $1,818, which is the amount that you'd be able to write off on your taxes for the next 27.5 years. Now, there is a more aggressive form of depreciation called cost segregation. Now, landlords usually depreciate all things that can be depreciated together over the 27.5-year period. Now, this is a long time, so you may ask yourself, well, what if you wanted to speed things up? Is there anything that you can do? Well, then you can use cost segregation. So rather than grouping all the items together, you can depreciate them individually. Now, this is a more complicated process and requires a cost segregation study, which must be completed by a certified professional who is authorized to conduct the study. Additionally, it does require a lot of detailed record keeping, But for you, it means a much bigger total depreciation each year for the first several years that you own the property. Personal property and land improvements have shorter depreciation periods than the building itself, usually 5 or 7 years, so they can be depreciated on an accelerated schedule. The total deduction does not change, but you do get it more quickly. You get it up front rather than on the back end. So you may wonder, well, why would someone want to do that? Well, to answer your question, the reason some investors use cost segregation is because if you take that money and invest it, you will have more time to grow, and there's no substitute for time when it comes to growing your wealth. So what are your guys' thoughts around depreciation and cost segregation? What area of real estate do you find most exciting? Please leave your feedback in the comments below. Now, if you found value in the video, please give it a like, share, and subscribe to the channel, as I am posting on a weekly basis. Thank you so much for watching, and until next time.